And welcome back to Energy Day here at the Global Supply Chain Week. My name is Kevin Hill. I'm the executive publisher here at FreightWaves, and joining me right now for our next fireside chat is Ben Shattuck. He's a research director for the Americas region, oil and gas for Wood Mackenzie. He's been there about 10 years since he graduated with his MBA from the University of Oklahoma and was an IFP in Paris, France. How are you doing today, Ben? Thanks for joining us.
Yeah, I'm doing great. I think the weather is warm back up in Houston. Excited to be part of the conference, and happy to have a chat with you, Kevin.
Yeah, let's start off in Houston. You're based in Houston right now, and Houston just went through a huge freeze, and we were having this discussion a couple days before it airs. So you're just now coming out of it here right now, right?
Yeah, we are. It was primarily last week. I think it was the first time ever that, every county in Texas was under a winter storm advisory. And temperatures plummeted, far below what we typically see in the state. And so that caused quite a bit of disruption, obviously in the field, out of West Texas, over 1.5 million barrels a day offline at peak, a few 100,000 barrels a day out of South Texas. Also, a few BCF a day of gas production was impacted as well. We saw all of that contribute to some of the power outages, which were felt by consumers, but also it was a bit of a circular reference then because, you need that power to operate things in the oil and gas field. So that's being phased back on. As we have this discussion, it's not necessarily always as simple as going out and turning a tap back on. Like I said, that infrastructure, not built for those temperatures. It can be built for those temperatures. We produce, in North Dakota, it's frequently that cold. But, when you don't insulate these things, you have equipment that cracks and breaks, and you have to be able to get back out there and do the maintenance on that. You have to be smart about how you bring that stuff back online. Producers in sort of the midst of doing that this week.
Yeah, later on today, we're going to talk to a group that handles petrochemicals in the refinery space, and we'll get some more color about those facilities, which are not designed to face freezing and 0 degree weather over an extended period of time. Your research and your coverage is America's mostly shale plays and in production, new drilling. Can you give us highlights of what exactly you cover there at Wood Mackenzie?
Yeah, so speaking for myself, I focus primarily onshore in the U.S. And so we follow very closely, all of the activity, but it's dominated, of course, by tight oil and shale gas production. There's been a renaissance. We are all quite well aware of that over the last 10 or 15 years. Oil production has grown from 2 million barrels a day onshore to over 8 million, 9 million barrels a day. And it was very much of a positive story, despite some price cycling through the last decade. If we talk about tight oil, it's at a bit of a pivotal point in time, I think, at the moment, because we've shifted from it being a relatively new and exciting and maybe not even that well understood technology, and we're sort of maturing into a phase where we understand the technology. We understand the impact that it has on price cycles. We understand the impact that price cycles has on the technology, and at the same time, investors are changing what they're asking for these companies and reevaluating really whether or not they even think that these companies are investable into the future. It's a really interesting time to have this discussion.
It really is. We talk about activity levels, and certainly, the last 12 months, you have the pandemic, you have COVID, you have gasoline sales and usage down here in the States. But, this downward trajectory of oil prices and production and investability started a couple years before that, and we're still in the middle of that cycle. So in a historic context, where does production activity and company investment, CapEx, stand right now?
Yeah, so it's a bit muted at the moment, and you're absolutely right. There was a pullback in terms of what was expected of these companies for years. Like any industry, the companies do really what big investors and shareholders ask for. And so over the last decade, that those targets shifted, from the amount of land that a company had to the size of the wells it was drilling, and then ultimately, for a long period of time, it was how quickly these companies could grow. And the idea behind that was that sometime towards the end of the decade, there would be a harvesting of cash flow. Well, in many ways, these companies were so successful at growing production that they produced so much that it had an impact on global oil market. And so prices fell, as we know, and that made it harder to generate that cash flow. Until finally investors got a little bit fed up with it. And so cash flow is now priority number one. So activity was already pulling back. And then 2020 happens. And, so the rig count is, West Texas, 50% of what it would have been a year ago today, although up by probably, 60, 70% from the lows in Q3 of last year. So the rig count is recovering. We don't expect it to recover to where it was at this point last year in the near future, but activity is trending in a short-term perspective upward, and a long-term perspective, benchmark to the last 5 years, it's a downward trend.
So if we look at this downward trend and think of reasons or key drivers that might increase production, increase new drilling sites, increase just really oil and gas activity over the short to medium term, let's say 1 to 3 years, what are some of the key drivers we should be looking for?
Yeah, there's 2 or 3 things that are going to be really important to track here, and they relate to the way investors will perceive the industry in my mind. The first is price. So much of this is price dependent. Tight oil historically has sort of drilled through downturns because there's a lot of excess capital available. That's not the case today. Prices are looking good at the moment. We're over $60 today. Hopefully on the day this airs, we're still over $60. But you need prices to cooperate. The second thing really that you need to see is progress on balance sheets. There are hangovers from last decade, and the big one today that's holding shale back in a lot of ways is the debt overhang. And so over the next 2 to 3 years, we need to see that middle chunk of operators, not the elite, but sort of the base of tight oil production, needs to get down. We've drawn a line at about a 20% gearing ratio. I think they need to get the arrow pointed in the right direction. At that point in time, I think if you have higher prices, you have debt loads coming down, and you start to see excess capital, then there's a decision to be made. And the decision is, if we have excess capital, do we give it back to shareholders? Do we keep buying back, or do we, variable dividends have become a bit of a mini trend? Or do we put that back into the oil field? If you're asking my opinion, I think in the short term you see money go back to shareholders. What that does is that over time wins trust back, and that maybe opens up that door to putting money back to work in the oil field again.
Do you think because we, the Freight Intel Group here, we published a DHL's PPI pricing power index and trucking. And part of that is looking at some Bank of America information that's published on a weekly basis on credit card and debit card spending, and we keep an eagle eye out on that. If you look back in last September of 2020, you saw gasoline sales were still 20% below what they were pre-pandemic levels. Right now, the most recent one in February I'm looking at right now is only about 5% down, and it's been trending up closer to 0% ever since that time. Do you think that we'll need to really get back to normal activity when it comes to driving and commuting and hopping on airplanes and resuming normal life to really see a strength in the industry and strength in increasing production with a purpose?
Yeah, it's a good question. I'm certainly not a gasoline demand expert. What I can tell you is this. Shale does need prices to cooperate, and prices will, in the long run, be a function of those fundamentals. And so the demand side is as important and potentially as uncertain as it's been in recent memory. Our view, in a nutshell, is that as it relates to COVID-19 and the pandemic, the destruction to supply, right? So the investment that's taken out of the system, budget slashed by 40+%, has a longer term impact than the impacts to demand. Like you said, down 5%, trending upwards from down 20%. It doesn't take you can just look around. I can look out the window here. I can see the number of cars in the HEB parking lot. Like I said, I drove, I did a 1,200-mile road trip over this weekend. The highways were packed. I think that there is, people want to feel mobile. Folks have been, at home for a long period of time. Travel is sort of one of those things that people want to get back to. So, our view is the impacts to supply are stickier than they are to demand, and so the read through on that then is stronger fundamentals, which could support increased activity in the shale patch in the future. Yeah, absolutely.
Yeah, you talked about supply a little bit earlier, and talking, really about investment when it comes to supply, and wringing out some of the excess or bad bets or bad capital in it. And the oil market's always reminded me of the trucking market, right? So rates rise, everyone goes out and buys a truck. You flood the market with trucks where supply outstrips demand, and then you have tumbling prices, you have bankruptcies, dissolvements, drivers go find another way to make a living. Sometimes it's the oil fields, a lot of times it's construction. And you have this balancing, and the oil market takes years to really string that out, because it takes a long time to go out and find, evaluate new properties, set up the drilling, and hit production, where in trucking it only takes a few months. So where are we at really in supply? And when it comes to the supply and where we go from here, and then the oil markets, what's your take on that?
Yeah, drawing on your analogy from the truck market, I would say that where we sit today is, sort of the painful part of that cycle. There's a lot of consolidation. If we think about domestically, where things tend to move the quickest, because shale is shorter cycle compared to international, and international saw investment, cut for a number of years while prices were lower, and we saw continued investment here. We're sort of, we're on the flip side of that, in my view, particularly as it relates to the shale patch. You're seeing consolidation, and you're seeing a streamlining of oil producers onshore, which is sort of a fancy way of saying, headcounts are going down. The cost side of the equation is being examined closely. So we're in the painful part of that. When we emerge from that, what that means is we'll have fewer producers who will be more streamlined. And so that means that at a given price, they can either generate a higher return or produce more oil than what we have under our current set of assumptions. It also probably means a little bit more stability from production onshore. Gone are the days of prices rising $10 a barrel and off to the races. We grow it at a million barrels a day. And I think what that does is it's a more stable contributor to global oil markets. But it's also, it helps the ancillary industries. And so when I say the ancillary industries, I'm thinking of midstream, I'm thinking a lot of oil field services, but it will have an impact on trucking as well. You need a line of trucks that's 5 miles long to drill a single well, and end to end. There's a big difference between 400 rigs and 200 rigs, and we've done that a number of times, and we think it's more of a smoother runway through this decade.
Ben, when you look at the new technologies that are coming into the oil patch, is there anything that's going to be revolutionary, like the horizontal drilling that we saw? I don't know, how long has it been now? 20, 30 years when horizontal came in to the picture. Is there anything out there that, especially as we get these shale fields are now becoming more mature, and oil's becoming harder to drill and to produce, or at least theoretically, right? Are there any new technologies or techniques out there that might revolutionize the industry again?
Yeah, it's interesting. You say 20, 30 years on the shale. Believe it or not, this week The first shale well ever drilled in the Barnett Play turned 40 years old. Now it wasn't refracked with a water frac until in I think the late 90s, but yeah, 40 years old. On the technology side, so much of what the technology story has been over the last 10 years is finding a way to, from the same well, produce more oil. So, increase productivity gains. We think largely, the productivity gain story is behind us. And in fact, we're seeing some of those trends reverse. So the technologies that are really more aimed at trying to stave off those declines. So nothing major really in the short term. You'll want to keep an eye on what the majors are doing. Exxon had some big developments last year that tried some new things out. Some wins, some losses on that front. I think longer term, one of the things that we haven't touched on at all is the pressure to clean up on the ESG front, and so much of the focus today is on the E and the environment, and you are seeing investments in technologies that are not cost competitive today on things like carbon capturing. Occidental Petroleum, sort of leading the first large scale carbon capture technology. Not cost competitive today, much in the same way that recovering hydrocarbons from Mill-Darcy reservoirs 40 years ago sounded, borderline crazy and insane at that point in time. So, do we forecast that this stuff takes off? These forecasts that extend this long are notoriously, wide error bands. But if you want some things to put on your radar, look at what Oxy and Exxon and some of these other companies are doing in the carbon space.
Yeah, I think thanks for mentioning that the carbon space, and we haven't we haven't covered the new administration yet, and kind of what that means for oil and gas going forward. What are your thoughts and first impressions of the Biden administration?
Yeah, so we expected change. Forecasting the extent of that change, it was really going to be quite difficult. The first week on the job, there were sort of a trio of actions, executive actions. So the first was the cancellation of the border permit for Keystone XL. We can discuss that if you like. It's more of an impact for the operator of that pipeline. We're still able to move the crude out of the Western Canadian basin to where we need to get it today. The other two are actions that, if they just expire, you would say it's a non-issue. But I think the key thing here is playing it forward, and so that's the moratorium, or the 60-day pause, I should say, on federal permits and in the review process on leasing new federal land. New federal land is not that big of an issue because most of what's good has been leased up, right? But not issuing new permits, that will certainly have planning units across the space sort of thinking about, how do we navigate this? Do we move all of our rigs onto federal units today in case we can't drill them tomorrow? Do we move them off because there are other regulatory hurdles headed our way in the near term? And so that's all split. What I can tell you is this: the impact to production and activity in the short term, so call it the remainder of the year, virtually non-existent. There are very, very few operators that don't have another place to operate, and it's very unlikely, really, that you could halt operations on the spectrum today. By the end of the decade, as we play these scenarios forward, you're looking at 5% of crude production, which is not insignificant, but it's certainly not a trajectory to killing the industry. It's the middle of the decade where you're looking at over 1 million barrels a day potentially of impact. But remember, there's another election in the middle of the decade as well. And so, playing it forward, it's really that 2023, 2024 timeframe where, if these regulations become more severe, you could see material impacts to activity and production levels. As it stands today, not a lot of impact, but certainly the message very much has been that there's more to come, and so we'll have to wait and see on that.
Thank you. The great insights on the administration and kind of what's happened so far, and kind of the long-term impacts, and also what might happen short term as well. We have about 90 seconds left in the session. As we look forward in 2021, what stokes your curiosity the most about the oil markets?
Yeah, to me, I think it's going to be really interesting to watch, and it's a more contentious question than people give it credit for. Is shale has always outperformed in terms of production, and it's been able to do that through spending more money, maybe than it should have. Q1 earnings look better than we would have expected. It's sort of a perfect storm of elements. Now, it's yet to be seen if the industry can continue to generate that type of cash flow. But I think what is ultimately going to be really interesting is, our view is that this excess cash pays down debt and is returned to shareholders. However, that's never been the case before, and this time it's different. It's sort of the phrase that makes more analysts wrong than any other. So I think that's the key question as to will we be wrong? There are certainly a lot of people on the other side of this debate that say shale will be off to the races again. So I think really watching what happens with things like variable dividends in the debt market, really on the balance sheet side of things. That's where the binding constraint on shale sits today. Watching that behavior, could usher in an entirely new era in terms of how this whole title machine functions.
So it's really follow the money, right? Look at the excess cash and how that's spent. If it's on new production or return to shareholders, that's what everyone should pay attention to that, right?
Absolutely, it's very tempting for West Texas executives. The old saying goes, "If you give an oil man $1, he'll drill a well," and that has certainly been the case decade after decade after decade. So it'll be interesting to see if 2021, 2022 are the year that changes.
Thanks, Ben. And join us for our next fireside chat and energy day here at the Global Supply Chain Week.